Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our June monthly market update. We hope to see many of you at our July 13th quarterly investment forum. We had over 100 attend in April, and hope to see many of you here in just a few weeks. So this may be what it feels like to consume all the information that is existing today and that markets are responding to. We'll try to break down a little bit of that today. First of all, revisit what we talked about last time, which is a kind of a market cycle using emojis, and talk about the irony that at the time of maximum financial risk is the time you're most euphoric, and at the time of maximum financial opportunity, you're the most panicked, angered, depressed, etc. Again, this is what's ironic about this is often people buy here and sell here. Not understandably, people are concerned about what's going on in the markets, as are we. If you look at 2021, we only had 7 days where the markets traded up or down 2%. That's on pace for 36 this year. The markets have traded down to a low of -19, now sit at -13. What you'll see, and we share this slide a lot, that even though declines are never positive on average, the decline within the year is 14%. Although 32 out of these 42 years, going back to 1980, markets were positive. So we're in the third worst start to the year for stocks, going back to 1926. So what's happened in those other periods? You'll see on average, the 4 months, first 4 months of the year down -12 on average. So we're kind of right at that number. Next 8 and 12 months on average, up 14 and 24.7%. This is a line chart that we talk about a lot. I'm going to focus just on the most recent kind of leg of this, which is pre-pandemic. We were at 3386 on the S&P 500. That dropped to 2237. Now we sit at 4161, even though that's a decline year to date. And if we zoom out and look at valuations compared to, for example, the dot-com bubble that burst, we're at 17 times forward earnings, which is much closer to average, and interest rates measured by the 10-year is right at 3. Keep in mind, not only were stocks much more expensive when the dot-com bubble burst at 25, but you could buy 10-year treasuries at 6%. So the jobs report was good this May, 390,000 jobs added, unemployment rate down to 3.6, and 12 months annual average hourly pay up 5.2. However, there's still a lot of job openings. So even though this ticked down a little bit, there's over 11 million job openings. So the jobs picture continues to be a mixed one. And Fed is kind of front and center, trying to, again, hit the bullseye, which is to curb inflation without bringing on a recession. Treasury Secretary just this week saying that we've ditched transitory as a description of inflation, saying she has expected inflation to remain high, although very much hoping that it goes down, and then bringing down inflation should be our #1 priority. Inflation, as you know, is high. Average gas prices for the first time ever at $5 today. 8.3 was our last reading. We get a reading tomorrow. Not expected it to move a lot. Although one of the things to follow is whether or not we've peaked at 8.5% a couple of months ago. 8.3 was our last reading, and again, we get a reading tomorrow. So again, the Fed is trying to be here between inflation on the one side and recession on the other. So kind of looking back, and again, whether the Fed will be successful in putting out the fire that they in part created will be a thing to watch the rest of the year. The Fed has already indicated that we're going to continue to get rate hikes throughout the year, probably 50 basis points in June and July, and then we'll be kind of more inflation responsive in the back half of the year. Going back, just kind of looking at bull and bear markets and their historical returns, average bull markets lasted 4.5 years with a cumulative return of over 150%. Average bear market, all of them painful. but lasted only 11.3 months with an average loss of 32. So how do markets, assuming we do go into a recession, how do markets perform? Again, the average length of a recession going back to 1926 is 13 months. The average return for bonds up, stocks flat, and the average stocks 1 year later at up 24. Interestingly enough, a contrary indicator with satisfaction being at 22%. The markets over the next 12 months, anytime it's that low, going back to 1979, average return above 15. We also see a lot of cash still sitting on the sidelines that could either be invested or be kind of pent up demand. So that could get into the economy and be measured by GDP. Anytime inflation going back to 1996 is this high, this is the average return over a 3-year period of time. So again, this is a positive sign historically with cash levels as high as they are. And taking a much longer view, just going back to 1926, we talked about this last time, 71 out of 96 positive years, the average up here at up 21, average negative down 13. Again, all of these painful, but nonetheless, they're the minority, and 2 to 1 is the average upside return versus the downside return. We did just rebalance. We shared some trade notes with you just a few days ago that spoke to our continue to be raising cash, tax loss harvest on non-IRA accounts so that you can realize some loss from a tax perspective. We continue to have energy and commodities positions, be overweighted US versus the rest of the world, and continue our move from more growth oriented at the end of 2021 to more value oriented today. We encourage you to contact us. None of this brief commentary is a substitute for talking about how all of these issues apply to you personally. So please leave no question unanswered. Please contact us if you have any questions. So with that in mind, we'll close. We hope again that you're well, and we encourage you to call us if you have any questions. We're here to help and serve you. Again, thank you for the trust and confidence that you placed in us. Until we see you again, take care.